Welcome to the 5-Minute Trading Edge, brought to you by the Institutional Edge System. Well, who doesn't love a good drama? Take it anywhere. Good drama is entertaining, and nothing better than classic drama, right? There it is, Romeo and Juliet. Of course, that's a play. Our friend Juliet thinks Romeo's dead. She's had enough. She grabs the dagger. She's going to go ahead and end it all. And that's as dramatic as it gets. Well, in the market, when news comes out, gosh, price freaks out. There's plenty of drama to go around, especially if you get something like a bad jobs report. And as a trader, it can be impossible to trade. The markets don't behave rationally. They make Romeo and Juliet type moves. And today we're going to talk about this and how to deal with it when it comes to news and volume, specifically when news makes price crazy. If there's a bad report that comes out and price reaches for the dagger and decides it's going to end it all right there and drops through the floor, or price gets really euphoric and raises through the roof, and you know that that's not sustainable either. We want to avoid getting caught with those fake outs and getting caught up in the drama that burns our account. And there's a way for us to enter into the fray after things have faded with macro volume on the reversal. And specifically what we're looking at is using macro volume levels as charted with order flow sequence tracking to know when price will finally calm down and experience a bit of a bump. Now, this is something that millions of retail traders don't have exposure to simply because they can't see inside the candle. Check this out. This is the jobs report, right? We get a bad jobs report. Here it is on the ES. 8:30 rolls around and price goes on a run. 29.52, and then the market really decides it's not happy. 4-0 imbalance, 35.46. We plow all the way through across. Well, this line right here, this is an institutional trading level. Thanks to the algorithms that are out there, thanks to the algorithms that are proprietary with the NOFT suite of tools, we're able to track historical institutional trading levels. And there's actually another one right there. So price freaks out. It comes all the way down. We're waiting for things to calm down. What am I doing? I'm watching this one and I'm watching this one. And when I have two of them in close proximity, I usually like watching the second one. Sure enough, we got some responsive activity and we got a sequential decline here, which you hear us talk about, which could be tapering activity for sellers. But look at this. It's not enough for us to move on. We wait to the following bar and price continues to tear down. We get these conditions again, but we have them in conjunction with a long-term volume level. That's important. We didn't have that up here, but we do have that down here. That gives us confidence that sequential decline and responsive activity are going to be honored. We track something right here then for reversal, and we're ultimately rewarded. Now the market may have grinded on a little bit, but out of the crushing volume and drama that we were dealing with, this was the moment or the reversal that we were looking for. So, news and volume, avoid trading with those retail masses that get caught up in the middle while price is barreling through and overreacting. Watch for imbalances and steer clear of crazed price. Specifically with those imbalances, we're talking about these guys right here, those red numbers. And then finally, stock entries with the macro volume levels. In the case that we just looked at, institutional trade levels. Before that, or as an alternative, you could look for volume rejection levels. If you'd like to see how you can profit from news and macro volume, watch our free 4-part training at institutionaledgesystem.com. Until then, good luck trading.